not a lot of change after somewhat of a drop yesterday. We've got Brent crude oil at 62.62, a few pennies down, but ultimately you'd have to say that in the swing of the early morning trade in Asia, not a lot of change after a somewhat significant drop over the last 2 days of trading this week. The big news of the day, of course, or of the week, of maybe even the year, perhaps on some level, although maybe not immediately reflected in the oil price, but the decision announced yesterday by the International Energy Agency to essentially abandon its energy transition commitment and sort of belief system, and revert back to, I suppose, what it says on the tin of the IEA for 50 years, which is more oil, please, tomorrow, every day of the week. Because that's essentially why it was created, the International Energy Agency, in the aftermath of the oil crisis of the 1970s. And their principal role was to ensure energy security for its member states, the OECD countries. But Mike McGlone, senior commodity strategist at Bloomberg Intelligence. Mike, I wanted to sort of kick off with your thoughts, your reaction when you heard the news of the day yesterday.
Oh, well, it wasn't really a big deal for me. I look at crude oil, it's a pretty enduring bear market. It's not alone, it's all with the grains, but it doesn't make much difference for me. That might be other people could comment on that. I don't, I just wonder where markets are going next. And the key thing is I look at crude oil's down
Well,
18.
I mean, where markets are going next, you are probably more than anybody on this podcast, or at least certainly amongst our commentators, heavily dependent on the data that you gather all the time. Of course, you don't go out in the field and dig up the oil and see how many barrels are there. You rely on a stream of data. The brand behind you, Bloomberg, is probably the greatest aggregate of publicly available data on the planet, and makes it into intelligence. Can you rely on this data now? I mean, ultimately, the data coming out of the IEA and other sources are critical for you to put together your forecasts and scenarios. It seems to me this is the year of the death of data, the death of statistics.
Yeah, I'm not worried about that so much. We have numerous other sources of data. So that's just one source, and there's plenty of one's checks and balances. And for me, the data is such a lagging factor. I'm always trying to look forward. So that's not a factor for me. Why I have analysts who do that. My more worried about crude oil is that data on a 1 to 10 is such a lagging thing, and maybe it's a 5. The key thing I'm worried about right for crude oil right now is if the stock market can stay strong. Because if it doesn't, WTI crude oil is going to head to a 40 handle. I think that's a matter of time.
Nadia Martin Wiggin, director at Svelin Capital. Nadia, we're just kicking off this morning with sort of gut check reaction to the IEA decision yesterday to essentially abandon its peak oil demand forecast and extend the sort of accelerating growth of demand for oil by a number of years out to 2050. I think one of the more extraordinary data points from yesterday with the IEA was the announcement that 60,000 people tuned into their press conference. I presume that data point was accurate and they weren't egging it up, but 60,000 people tuned into the IEA press conference yesterday after they had sort of signaled their decision and abandoned their sort of forecast. Your thoughts, reaction, Nadia, and you're still on mute.
There we are.
There
Okay.
we are.
So I think, first of all, that's a great statistic. People are re-engaging in oil. That's what it means to me, and they are concerned about the future. I think the hint that something like this was coming was when the IEA published their decline study showing field decline in oil. It was updated from 2010, which was pre-shale, which mean when we have much higher decline rates in the shale patch. So I think that really motivated their revamp of the entire system. I think the report, although I haven't read the whole thing in detail, but skimmed, it's much more balanced. And I think it's showing that the industry and the world And everyone is not scared to talk about the need for oil and gas in the future. And this is where they made a big change on oil, in that the current policy scenario doesn't peak in terms of demand. First of all, in the past, now, or even in the future, it just keeps rising to 2050. But also on the gas side, this is where they had gas peaking, in their 2022 iteration before oil. And this is where I think there's a big difference there. The part that concerns me, and this is when we'll talk about OPEC later, is there's still this built-in assumption that coal will decline in terms of use. At the same time, when we have US coal use increasing and we have US commitment to renewables dropping by about 35%. And this is what is really, I think, changing that current policy scenario in that outlook. But I think overall, it's a great report. I think it's more fair because it's showing where we are today and where we can possibly go. And I know there's been a lot of commentary, can we even trust the IEA and these sorts of things? And I think this is a much more fair report. They're a big organization. They had to go through the rigorous process of updating their decline rates, something that the industry already knew. And then they're pointing to the investment needed. We're talking about $14.9 trillion of investment in the upstream. I think they're... And OPEC points to the same thing. And then we need to invest in the downstream and the midstream. And I think the expectations there are a little bit low on how much we have to do there to actually utilize all this oil. So that's my summary.
Shoaib Boutamin, Energy Advisor and CEO of Ranadrill Energy, sitting there in Algeria, of course, one of the OPEC member countries, a big North African producer of oil and gas, big gas supplier to Europe. OPEC was doing a little bit of a victory dance yesterday, Shoaib. Do you think that was the sort of appropriate response?
Yeah, I think now the International Energy Agency is accepting the reality. The reality is all oil is still, we still need oil, we still need natural gas, and we still need even coal. Even we had a lot of pressure the last few years on fossil energies. I have to remind everybody that the world still are lying on 80% of energy supplies coming from fossil energies. So I think that International Energy Agency is aware that they have one thing to highlight. There is no gas turbines in the market to generate electricity. There is a lack. It means that we still need a line on natural gas and even for oil. And this is the reality. All the time, the OPEC and OPEC Plus was really calling that we still relying on oil, and International Energy Agency was all the time talking about the plateau, the demand of oil, and this is not really realistic because we still need oil. We still investment is running.
So the question ultimately is has anything changed, or the IEA were just getting it wrong? I mean, has Trump changed the outlook for demand for oil because ultimately policies and focus and abandoning transition policies, has that changed the demand trajectory, or the IEA were just wrong and now they're getting a little bit righter?
I think both. It's depends on the Trump, but his withdrawal from the Paris Agreement about let's say climate change and all that stuff. And the second thing is the reality, what we have in hand. If we talk about renewables, Sean, renewables generate electricity. That's it. But oil and gas and coal generate electricity, and we need them for fertilizers. We need them for the industry and for the global economy. So we cannot really exclude. Now the language today is we add energy to what we have. So it's not like to exclude any kind of energy. We talk about the energy mix. That's the reality that we are talking today. But we don't have the right to say that we have eliminated this energy. So the OPEC now, I think that International Energy Agency is adhering to what OPEC was calling before, that we still need oil, not for 2 or 3 years, it's for decades. And this is what we are calling all the time, but we say that oil is sitting with us. So now maybe we could face maybe challenges we are facing now in the future is we are facing the lack of investments because the result of the calls to stop investing in oil and gas the last few years. And you know that in the banks in Europe and other countries, when you go to get to finance for them, they find investors struggle to get those loans and the credits to finance the oil and gas, let's say, project. So now I think the problem now in the upcoming years is that we'll find the problem of how to finance, or that's the result of lack of finance in the last few years. If we have
let's go to Mike on that. Mike, in terms of the curve bending here, this announcement comes in the middle of the COP30 in Brazil. The trajectory towards the energy transition, and that point. Does the access to capital now, does this sort of change? I mean, this is not the beginning of the change. CERAWeek last March, you already had all the big IOCs starting to sort of sing off the same hymn sheet, the transition is dead, et cetera, and so forth. Does this change access to capital and other things allow for more oil to flow? U.S. oil production has been remaining pretty flat this year.
The number one reason it's pretty flat is because prices went down. There's less incentive to produce. The key thing about this report is 25 years from now, none of us are going to remember it. And one thing we have to remember about technology, it's not linear, it's convex. It happens that rapid, that fast. And we're replacing fossil fuels with technology at a historic pace. Now, yes, we still use them, but we can create more of it. The problem we have in this country is exports now. It's something that's really shifted. And a lot of that includes biofuels, which is rapidly advancing technology. And just the fact my EV is almost 11 years old shows you where things are going. So this report to me is, it's great, but no one's going to care about it for 25 years from now. And if you look at the S&P 500 top 20 or 30 companies, a lot of those did not exist 25 years ago. So it's not, to me, this is great. But for now, back to the oil market and commodities, is we have a pretty significant bear market. And I don't know what's going to stop that at the moment. But, you know, for now, this is a great report. But
we'll be remembered in 25 days. Never mind 25 years. We'll be remembered in 25 days, Nadia. What does it change on the curve to you, Nadia? We have... does this make oil and gas companies more investable? Does it bring them back into pension funds? Will the Norwegian, you're sitting in Norway with the next door to the world's largest sovereign wealth fund, and they sort of made announcements in recent times to move away from oil and gas, hydrocarbons. Does it change the curve on where the investment community sees places to put their money and their savings?
Well, I think it can change things, but of course it's going to be step by step on that side. I think when it comes to political influences and so forth, I mean, it's very individual and there are rules and regulations set. But I think this general pullback from oil and gas can come around if the returns are there. And that is the main concern. And this is where I think Mike, when he's talking about the near term, there is a lot of concern. We've been hearing about this supply glut for ages, most advertised ever. And this is where I would also like to compare contrast. You know, we also had the monthly reports out. And if we think about the IEA versus OPEC, the IEA has been the most aggressive in terms of the amount of the glut, talking about 4 million barrels per day build next year. OPEC has been more in the 2.2 million barrels per day camp for next year at a lower level. And I think the massive assumption there is that the IEA thinks that things are going from bad to worse in terms of the global economy, in terms of trade wars and so forth. Whereas OPEC takes the view that by second quarter next year, we're through that and things are actually improving. And that's what drives that front end. And this is where the front end of the curve of the, you know, the Brent curve, the WTI curve, that drives the investment. And we've had WTI dip into contango as we finally start to see some inventory builds in the peak refinery maintenance season, as we should. And we don't see that yet in the Brent curve. And that will, I think, drive whether the investment goes into the upstream or, for example, if it goes into the downstream. And this is where OPEC makes a super bullish case for the downstream. They expect refinery margins to be 16% higher next year than this year. And it's at the same time when the Middle East is investing in refinery capacity. So I think that the way they think about the oil market is changing. They're thinking more about products. They're thinking about the curve. And as they have this production group, I think they're still indicating by that pause in bringing back additional barrels in Q1 next year that they do not want a deep contango curve that builds storage across the world, that turns all of this oil into the water, into floating storage, and then incentivizes that pulling out of storage oil instead of additional production out of OPEC. I mean, in 2050, they expect their market share in their long-term report to rise to 52%. That's a big call.
That's back to the good old days. Shoaib, on that point of the more immediate outlook, OPEC Plus have announced their decision to pause with increases come January. Your thoughts, how long will that pause last before they actually start cutting?
Yeah, I think it will depend the market reaction. We are passing through this period. There is now high demand on oil. It's opposite to natural gas. This period we have more natural gas demand because of winter, so it's needed for heating. I think now the issue with OPEC now, we have some issues with the sanctions imposed against India. Let's say the tariffs of 50%, and even the sanctions imposed by Western countries on Lukoil and Rosneft, Russian. So these companies are providing like 60% of the Indian oil. And I think this is where we are living a very tight market on that side. So these sanctions, I think, will contain the range of Russian export. And by the way, I think as I was reading a report that there is a discount of the Russian oil of $20. And this is a huge number, $20.
Very tempting, very tempting.
Exactly. And I think we know that in 2021,
even the Norwegians might be buying it at minus $20.
Exactly. It could be an opportunity for other
OPEC. Very unlikely.
Yeah, that could be a good opportunity for maybe for Iraq, for Saudi Arabia, and even for UAE to, let's say, to reconnect with their traditional customers, which is India. Let's remind everybody that 2021, the Russian share in the Indian market was only 22%. At the moment, it's 34%. So this could be an opportunity for these countries to recover their market share. So this is one of the big issues. And talking about International Energy Agency, which last 2 weeks ago reported that we'll have 4 million barrels of glut per day in 26. I don't know how they counted that number. I don't know. If we talk about glut, it could be the Russian oil, but not the oil from Saudi Arabia, of North Africa, and other regions. That could be the glut. But that glut, if it's not accessible, we cannot call it a glut because there are sanctions on let's say, on the producing.
I mean, you can say the same about spare capacity, can't you?
Exactly,
I mean,
exactly.
It's not spare capacity unless you can really access it. Let's go to the survey question and get a view of the room on this IEA decision. The IEA decision to abandon peak oil demand forecast will have greatest impact on boost bank lending to oil companies, accelerate end of energy transition, reduce trust rather than trusts in research and data, has no impact. The IEA decision to abandon peak oil demand forecast will have greatest no impact. Reduce trust in research and data. I mean, ultimately, it seems that the IEA mirrored the Biden administration's principal policies on energy, and now they're mirroring the Trump's, who are their biggest shareholders, I suppose. Ultimately, the IEA is not an independent agency. It shareholders like all of us, and they are known OECD members. Mike, looking at the news of the day, other than this, obviously you have a government back. I don't know, is that good news or bad news to you? But ultimately you do. Does that move the curve at all on the outlook for the US economy and energy demand?
Well, it's better than a shutdown, I suppose. It's going to take a rebuild, but I think what's going to happen, what I'm afraid of, is now we have about a month and a half, almost 2 months of data. Some of it will still be catching up on, and a lot of the data is turning somewhat negative. That is why the Fed did cut. So overall, from an economic standpoint, it's going to really pressure the economy. We're seeing a lot of signs of stress, despite the fact we're having a record-setting stock market. So that's a bit of the oxymoron. What I find quite concerning is we see gold just keeps taking off. That's not a good sign. So for the overall U.S. economy, one thing I'll point out is we've never had a situation where gold's been up this much and crude oil's been down this much on an annual basis. So on a global basis, it looks like a problem. The way I see it from a U.S. standpoint is the U.S. stock market absolutely has to stay resilient, because if that tilts down, everything does. Even copper will have a big problem, particularly crude oil.
Well, I suppose the U.S. stock market is the U.S. economy now, isn't it? In a great extent, 200% of GDP. Everything is moving with its health determines everything. Nadia, just on the point, we've just come through a sort of earnings season, Chevron reporting yesterday, and their outlook is very much about committing to the serving of shareholder returns, dividends, and less focused and less committal to the idea of investing into further capacity. I mean, whether this sort of outlook for IEA changes anything for that, but ultimately, where you see going into 2026, the appetite for the publicly traded oil and gas companies to invest in expanding capacity.
Well, I think the communication from Chevron's very important, because since COVID, we've had a huge lack of interest in the industry, and that was really driven by the fact that dividends were cut. And that, when Shell cut their dividend, that historically, that was a big game changer. And all of these companies know that they have to earn back the relationship with their shareholders. So that's why that continues to be the focus. And it's very sensible, where they're announcing on a day when the WTI curve was dipping into contango. So, seeing is believing, and that's where the price is. And the market is very bearish and expects the price to go lower.
On that point of contango, WTI dipping quicker into contango than Brent, what's the dynamic that's different between the two? Will Brent follow?
Well, that's the question everyone wants to know. It is, and if it were to start falling, will OPEC then pull back on production? I think the number one question is what happens with Russian oil, and what happens with Chinese stockpiling. That's what's really going to be that near-term determinant. OPEC assumes they're still going to stockpile 500,000 barrels per day next year, the Chinese, versus 800,000 barrels per day year to date. Let's see. The EIA assumes that. So we'll see on that side what happens in those dynamics, because we have effects. I see that only around 250,000 barrels per day of Russian crude has been exported higher since these big refinery outages we've had because of the Ukrainian drones. So something is not ticking there. And is it a production issue? Is it a shadow fleet issue? Is it a delivery issue? Because the port of Rizal that's been sanctioned in China right now cannot take 500,000 barrels per day of additional Russian crude, even though if it is at a $20 discount, the price incentive's absolutely there, but it will take time. But one thing I want to just comment on that Mike mentioned, that the state of the world isn't good when gold is so strong relative to oil, but there's a big difference. The number one driver of the gold appreciation is central bank buying, and it's not, driven by economic panic. It's driven by two things. One, in Central and Eastern Europe, yes, it's concerns about war and neighboring Russia and being near Russia and shoring up finances in case there needs to be a war. We saw that the Russian central bank bought record amounts of gold for the 2 years before they invaded Ukraine, and now they're the biggest sellers in the market. And then we have the BRICS countries. And we have the ex-Russia, but we have this feeling and concern about the US dollar, about sanctions through the US dollar, and this moving away and diversification away from the dollar and towards gold. And this is where we continuously have treasuries coming due for the Chinese central bank, and then they're buying some gold on the side while they also buy treasuries. And this is a momentum that we expect.
Well, I
to
mean, they are
continue
declining.
regardless for years.
They're not buying. They're clearly the Chinese clearly decreasing their treasury percentage of their total down by 50% over the last period. So what are we hearing here? 40% reduced trust in research and data. Some interesting thoughts there. Mike, looking at where things are going vis-a-vis the U.S. outlook here, the idea that the economy is going to have another Fed rate cut, but in the U.S. just sort of pure macro numbers coming out of the government shutdown, it's hard to tell, is the U.S. economy in a good place? Is it in a bad place? What is your assessment as to the health of the U.S. economy as we come to the end of the year? Are the Fed being guided by job numbers, by inflation? Where are we at?
Well, definitely, there's clear signs the economy is weakening from an employment standpoint. That's been happening for a while. The key thing is inflation. We just had an election, and there was a Democratic sweep in all these elections, mostly state and local and city, New York City. And the number one issue was inflation. And the number one thing that's pushing up inflation right now is, unfortunately, the stock market at 2.3 times GDP. So that's Trump's lose-lose. He's trying to push up the stock market, wants the Fed to ease. That's part of what is helping gold. Nadia mentioned the other central bank buying is quite significant. But at the same time, it's the lose-lose. And we've just reached that end game where Chairman Powell finally pointed out, oh, by the way, I'm not supposed to be adding to the punch bowl when the party's getting out of hand. So he said, we have to curtail easing for a little while. So I think we're getting towards that end game that things like gold and crude oil figuring out. And that is, all we need is just way overdue for a recession in this country. And the number one catalyst for that is just a little bit of a reverse wealth effect.
What about, just to Mike, to speak to it seems there's some divergence between gold and Bitcoin, which were both rallying quite dramatically through the year and until their pause in October. Gold seems to have started again, Bitcoin less so. Do we have a departure here? Bitcoin being sort of risk on appetite, gold being more about risk off?
Well, I'm glad you mentioned that because it's classic peak risk asset type activity in things like cryptos and Bitcoin. There's been a pile effect into ETFs, into very poor performance, and we reached pretty significant milestones. So I've had a love-hate relationship with the Bitcoin and cryptos. When Miss President Trump 1.0 hated it, I loved it, and now that they love it, I hate it. And I think that's what's happening. That's the tip of the iceberg of risk assets. It's starting to roll over. It's divergent weakness in all the cryptos, which means the stock market's next, and that's why I point out is crude oil, I think, is figuring it out, and copper is probably the next one to have a problem.
Troy, but I wanted to have last word with you on where OPEC is in all of this, because one of the big sort of decisions or the big kind of explanations as to why OPEC Plus has been increasing their supply quotas this year is to try and find where the reality is in terms of production base levels for all of their members so that they can set new baselines. Has that been achieved? Do you expect that to start to come into reality into 2026? What are your views on that? Where is your country, Algeria? Have you now come to your reality?
Yeah, I think, as you know, Sean, the OPEC started in let's say 138,000 barrels from April, and to last one will be in December, 137,000 barrels. I think this will be like approximately 2.9 million barrels per day, and this is still half of the total. Let's say a total of 5.85. I think that this is like a right time to stop this let's say this unwinding, because there will be low demand in this season and the upcoming month. Now,
is it the right time to stop because nobody else can increase?
I think they should stop before, not now, because anyway, this is the OPEC organization. They decided that. But I think And my question is whether they will resume maybe in March or April. I think it will be very tough because with the sanctions on the Russian oil, I think will be like tightening the market. And I think with the winter less demand, I believe that OPEC can resume maybe later, maybe in June or July, but not in the upcoming Q1 and Q2. This is my opinion.
It certainly seems like the big question. The IEA, obviously, the press conference and report yesterday is very much about the long term, but I suppose the most immediate is how biting will these sanctions be? This time I'm serious, and it seems to be maybe actually this time is different, that the sanctions on Russia, the Indians seem to be buying into it because they seem to have found a nexus with the tariff, the Liberation Day tariff agreements, and these added sanctions on Russia have found a nexus that the pathway to a tariff agreement with Washington is stop importing Russian discounted oil. At least for the Indians, that seems to be a determining factor, and for some others. So let's see. That will be the question. How biting will these sanctions be on Russia? And then other things can fall from the point of the immediate. But we'll have to leave it there. Mike McGlone, thank you as always. Great to have your insights. Shoaib Tabeen and Nadia Martine Wigan in Oslo. Thank you guys for sharing your thoughts today. As Brent is little changed, but when it's not doing much, it seems to be falling. That seems to be the mood of this Brent market. When the noise stops, it wants to drop, and it's when the fizz noise comes back, it tends to rise back towards 65. Will there be any fizz to lift it up over the coming days? We'll see. All the best, guys. Thank you.
Thank you.
Thank you.